All right, let's get you some exclusive news. While the government has clarified, and I think I'll just get this piece of news going, because while the government has clarified that there will be no tax on under or overpricing of shares between Indian arm and parent entities under transfer pricing cases, top sources tell ET now that North Block is considering a proposal to impose capital gains tax on the parent. Suchitna Ray joins us with exclusive details. Suchitna, fill us in.
Neeraj, we have to remember that the government is trying to put a lid on the transfer pricing controversy in India. But top sources in North Block tell us that the government, at the same time, is seriously considering a proposal wherein these parent companies will have to pay a capital gains on the shares that were transferred to it by its Indian arm in the eventuality of these shares being sold to a third party. We have to remember here that North Block says the logic behind this capital gains tax is that the underlying assets are in India, and therefore India should be the recipient of the capital gains tax. We have to remember also that India has double taxation avoidance agreements with more than 85 countries, which clearly say that if the assets are in India, then it is India where the multinational company, wherever it is based out of, should pay the tax. We have to also remember that it was the Indian government just a few weeks back who said that underpricing or overvaluation of shares, when they're being transferred from the Indian subsidiary to its parent company, will not be taxed in India. And that is in a way that the government forgoes some revenue. But the government, sources tell us, in all likelihood will also issue a clarity on the same issue in the upcoming budget by saying that in the eventuality that these same shares are sold further to a third party by the parent company, then the capital gains that arise out of it will be taxed in India. Remember, this is going to be a very bothersome issue for multinational companies who are hawkishly looking at the budget that Arun Jaitley will present in just a few weeks' time.
Thanks for that, Suchetna. Well, the key word also is that will be levied prospectively, so maybe that is just that little bit of a solace, if at all, because otherwise in the past we've had some unpleasant experiences as well. But let's talk about this in great detail with Dinesh Kanabar, CEO of Dhruv Tax Advisors. He joins us right now on the show. Mr. Kanabar, good having you. Thanks for joining in. Now, one, whether such a clarity is welcome, and two, would this be viewed hawkishly by MNCs?
Sir, I was just hearing what your correspondent mentioned regarding the proposal. And actually, to me, it sounds a very fair and a reasonable proposal. And I really don't see this as being anything negative at all. So let's take two situations. Situation number one, where the direct parent of an Indian company makes an investment in India. And that investment, for example, is made at par. Although the tax office may view that the investment should have been made at a premium. The tax office now clarifies that such a transaction cannot give rise to any transfer pricing implications. Now, obviously, when shares are subscribed to at par, that is the cost of the shares. And if tomorrow those shares were disposed, the capital gains is on the cost minus the actual cost, or rather sale price minus the actual cost. And since the actual cost is par, that's the deduction you would get. So I don't see really any reason for anybody to get worried about what the finance ministry is saying. In fact, that's the only logical way to look at it. I don't think anybody would argue anything to the contrary.
However, I'm just saying that this would require a fair amount of clarity stepwise on how it would be implemented, and whether there would be exceptions to the rule if indeed the government goes in with this kind of a capital gains tax imposition, because it would be a bit unnerving superficially if one were to just look at the broad contours of such an announcement, Dinesh. Or do you think that the government would be very clear in how this tax implementation will come by?
No, actually, there is no ambiguity at all. I'm sorry to sort of present to you a different view. I don't think really there is anything negative in this aspect at all. Capital gains, as I mentioned to you, represents the difference between the sale price and the cost. If the cost is a lower cost because that is the price at which shares are acquired, then the capital gains would be on the difference, no question about it. The issue really which would come up, which is slightly different, is if the foreign parent does not sell the shares of the Indian subsidiary, but the foreign parent itself is sold, which is when the amendment which was made to Vodafone-like situation of an overseas transfer would come in. That indeed is an issue, because there are a number of open issues there on what constitutes substantial value in India, etc., etc. But that apart, the fact of the matter is that if shares are subscribed to at a particular price, then the capital gains has to be computed with respect to that price and no other price. So I really don't think this will unknow any foreign entity. The only issue, I repeat, would be if the foreign parent itself is sold, which is a separate issue altogether, and that's an issue which does require a number of clarification, for which representations have already been made, and hopefully we will see some action on this regard in this budget.
What kind of clarity? And that's the question. Mr. Kanabar, we also have Mukesh Bhutani joining in to speak about this. Request you to stay on as well, because I would want both of you in this. Mr. Bhutani, Dinesh Kanabar out here is saying that if at all this clarity on transfer pricing comes in about, and if there is capital gains tax levied if parent sells shares transferred by an Indian arm, it will not be viewed negatively by MNCs at all, because it's probably only logical, and as long as it is done prospectively.
Well, I don't know whether in the first place there is any need for the government to clarify something as basic and as fundamental as this. We are dealing with two aspects over here. One is an aspect which seems to have been settled, that there is no case of transfer pricing if shares are issued. The second aspect is with respect to chargeability under capital gains provision. Now, obviously, if there is a difference between the sale price and the price at which the shares were bought, there is going to be an incidence of capital gains tax. The fact that a capital gains has occurred when the transaction is occurring between two related parties, I mean the buyer and the seller both are related, that would be subjected to transfer pricing rules. So we are dealing with two different aspects altogether. So I'd firstly question the wisdom whether in a situation we find ourselves in, whether there is any need for us to tamper with the law, which otherwise seemed to be a settled position, or we are trying to say something independent of the controversy that has arisen and settled. So I have not been able to understand, the rationale for carrying out a change of this nature.
Okay. So before I ask you a question that I wanted to ask you, Mr. Kanabar, would you want to add something to that?
I agree with what Mukesh is saying, that this is the basic proposition. This is exactly what the law is, that capital gains constitutes difference between sale price and the cost. It does not need any clarity at all. This is the legal position.
Okay, just
unless after reading the proposition, there is something else which comes up which we don't have before us, and therefore cannot comment. But otherwise, this is the stated legal position.
Yeah, of course, but which is something that we'll only get to know if at all there is something else that comes out, which probably will come out on Feb 28. But just one final word from my end, at least, Mr. Bhutani, is this, that what happens in the case of a transaction done abroad, and therefore would there be clarity required there? Because otherwise this seems to be a plain Jane logical thing that will come about.
You see, at the end of the day, if you want to make a capital transaction exigible to transfer pricing provisions in India, first of all, it should satisfy the fundamental condition that there is a capital gains that arises. Whether that arises in India or that arises overseas is a secondary issue. Having come to that determination, then you apply the arm's length principle. Now, if the government is trying to confuse this whole debate on carrying out an amendment to the transfer pricing law because of indirect transfers or because of controversy that has arisen, I think it should state so in the first place. Because without stating so, one cannot make out the very nature of amendment that they want to undertake and trying to unsettle a principle which otherwise has been put to rest.
Okay, but I doubt that would be the intention. If at all, the last couple of months, anything heard from the government seems to be that they want to simplify things as opposed to make it confusing. But gentlemen, I appreciate you joining us today for a quick perspective out here and giving us your views. Thanks so much, both of you, for joining in for this quick update. So clearly, there is clarity on transfer pricing coming about, and it might actually be welcome. And But my simple point is this, that MNCs may not view this negatively, and I doubt that any kind of retrospective tax amendment of any nature is on the anvil at all. We've had one bad experience, and I think nothing like that could probably come again. So fair enough, we'll wait on Feb 28 and see what clarity comes in out here. But speaking of Feb 28 and the budget, we did a global view. Sanjeev Sanyal of Deutsche Bank, Robert Parker of Credit Suisse, and Noriko Kuroki of JP Morgan Asset Management make their call for the upcoming budget. The focus being expanding